Going on, everybody? What's going on? What's going on? Hope everybody is doing well today. Hope everybody is doing well. The market has not been kind to us, but it depends on what side of the volatility you've been on. It also depends on your perspective. It depends on, are you trying to gear up for the long term right now? Are you trying to build your portfolio? Are you looking at your watch list? Are you evaluating entries for companies? Are you preparing to go long once we get some clarity and some understanding from the market? Okay, that's what we have to look at. And so, yes, we had pretty much the worst day we've had since 2020 yesterday, the S&P being down 4.3%, the NASDAQ being down 5.1%, the Dow Jones being down over 1,200, I think almost 1,300 points at one point. Very, very horrible. Like, it's been very, very horrible. But guess what? Today, we're going to put that to the side right now, because today is really, truly about understanding how to build wealth using the tools that we have at our disposal, learning how to trade options in the stock market, and learning what we need to do to build wealth, because we're going to hear a lot of noise. We're going to hear a lot of bearish activity, but you know what? This is the opportunity, okay? Like I always say on my Instagram, let's make building wealth a priority for our life. Let's take the time. Let's take the time to make the commitment in order for us to understand what we need to do to be successful. So, as always, welcome back to another episode of the Trade for Yourself podcast, where my mission here is very simple. I just want to help you learn how to trade for yourself. Please okay? Please like this, okay? Please subscribe. Make sure you hit that notification bell so you can be in the know every single time I drop an episode, because I may not drop an episode only on Wednesdays. I can always pop up at any given time, because guess what? Making wealth is a priority for my life. Understand this. Look, disclaimer, I'm not a financial advisor, nor am I a fiduciary. I'm not an economist, okay? I'm not a member of the Federal Reserve. So please do your own research before investing into any stock. I really, truly don't want to belabor the time anymore. So let's go ahead and get into the topic for tonight: how to trade options, okay? Episode 35 of the Trade for Yourself podcast. I've been doing this since January, okay? And so today we're going to talk about how to trade options. We're going to go through the entire breakdown from start to finish, understand what I look at when I trade options. So let's go ahead. Let me share my screen. Let's get into it. Let's get into it. All right. So let's get into it. Now, how to trade for yourself. Okay. How to trade for yourself. All right. Intro into options trading by your host, Devon Elder, host of the Trade for Yourself podcast. Now, who am I? I want to introduce myself to the people that are just getting hyped to the channel, just understanding what's going on with the podcast. My name is Devon Elder. I'm an investor, civil engineer, and the host of the Trade for Yourself podcast, where my mission here is very simple. I just want to help you learn how to trade for yourself, okay? I want to help people learn how to trade and invest in the stock market for themselves. Specifically, I help with the ins and outs of long-term investing and trading leap options, okay? I began my building wealth journey in March 2020 when the market crashed. I didn't know what I was doing at that time, but over time, I found it to be purpose work. I really, truly understood that people need help with this. People need to understand how to build wealth. People need to understand the tools at our disposal when we're looking at the stock market. And so this is purpose work. And I'm really, truly here to help y'all learn how to trade. Please subscribe to the podcast. Please like this. Please subscribe, because this is going to help get out to other people that need to see it as well. And follow the Trade for Yourself podcast on YouTube and all other major platforms: Apple, Spotify, Google Podcasts, Anchor. Follow me on Instagram at Mr. Devon Elder, okay? Like, tap in. Let's tap in. Follow me on TikTok at Devon Elder as well. Okay, so what are options? Okay, what are options? Options are financial derivatives that give buyers the right, not the obligation, to buy or sell an underlying asset at an agreed upon price. So, in layman's terms, options are orders of magnitude more volatile than the shares of the security you are trading. So this is different from trading shares, and we're going to talk about that in a little bit. When you purchase an option, you are purchasing a contract, and each contract represents 100 shares of the underlying asset you select to trade. So, for example, if you decide to get an options contract on Apple, that contract will represent 100 shares of Apple. There are three important elements of each contract that you must know before purchasing. You must know the premium, you must know the strike price, and you must know the expiration date. Now, what is the premium? Premium is the price you pay to buy the contract. For example, if the premium is $5, it will cost you $500 to purchase one contract. Let's look at the breakdown. Remember, every single contract represents 100 shares. So everything you see here, you're going to have to multiply it times 100. So $5 for the premium times 100 shares, that equals $500. Now, the strike price, the price at which you can buy or sell the underlying asset, which is also known as the exercise price. In other words, the strike price is the price that we want the stock to reach. We want the stock to reach the strike price. In the perfect world, we want the stock to reach the strike price, and we really needed to exceed past that strike price so we can get in the money, okay? Expiration date, third thing, the date the contract expires. If your contract expires in the money, ITM, you can purchase 100 shares of the stock at the strike price of the contract, okay? If your contract expires out of the money, OTM, your contract becomes worthless, resulting in a loss of your entire investment. And so this is why I want us to understand the strike price that we select is the price we want the stock to get to. Okay, the way that I want us to be trading, I want us to be out of our contracts long before they expire. That's what we're going to talk about. Okay, look, if you're in the chat right now, please ask any single question that you see on this slide so we can answer your questions real time and really truly have engagement so we can give us the tools, we can have that foundation, and we can move forward. Now, for example, let's use a real world example to describe what I'm talking about here, okay? Let's say you're in the market for a car, okay? When you're in the market for a vehicle, you only have two options, okay? You only got two options. You can buy the car or you can lease the car. Now, having shares provides you ownership. Having options provide you control based on the parameters you agree to when purchasing the contract. Let me give you the example. Buying a car is like purchasing shares. Leasing a vehicle is like purchasing options. Whether you finance or pay cash for the purchase of a vehicle, it's yours, okay? You can, once you pay it off, you can sell it for whatever the value is at any time in the future. It's yours. You can sell it to anybody at any given time for any price that you select to anybody. It's yours. There's no expiration date, okay? When leasing a car, you enter into a contract with an expiration date. It's got terms on the contract based on what you agreed to. At the end of the lease contract, you have the right, not the obligation, to purchase the car for an agreed upon price the dealership agrees to. Think strike price. If you buy the car, that will be similar to exercising your options contract, purchasing 100 shares of the stock at the strike price and being in the money. Like I said, we want to get to the strike price. We want to get to the strike price and exceed past. We want to be in the money. That's our favorite position, y'all. The position you want to be in is in the money. If you release the car back to the dealership, you would leave with nothing, or you would have to enter into another agreement for another car. That would be similar to your options contract expiring out of the money, which means your contract is worthless, resulting in a loss of the entire investment. At the end of the day, the goal is to sell your options contract for a sizable profit long before the contract expires. I'm going to say that one more time. The goal is to sell your options contract for a sizable profit long before the contract expires. We're going to talk more about what that means. Now, when trading options, you can only lose the amount you put in. You can only lose what you put in. Pretty much what that means is just don't over leverage yourself. Okay. Don't trade on margin. Don't borrow money from the brokerage. Don't do that. Okay. Just trade with the cash that you got. Okay. Trade with the cash that you got and use that. You know what I'm saying? Because I want you to be successful and I would really like for you to be conservative so you can make some money. Now, options terminology. Let's talk about what we need to talk about. Okay, so call. What is a call? That's what you select when you're bullish on a stock. When you want the stock to go up, you're going to purchase a call betting that the stock is going to go up. Okay, puts. This is what you select when you're bearish on a stock. It's what you select when you believe that the stock is going to go down. There are many Greeks that are involved with an options contract, but there's really only two Greeks that we really care about. And that's delta and that's theta. Now, delta measures the rate of change of an options contract for every $1 movement in the stock price. It also measures the percentage chance of the contract expiring in the money, our favorite position. Now, breakdown. If delta is 0.5, that means the value of the contract will move $50 for every $1 move in the price. Now, remember, every single contract represents 100 shares of the stock we're trading. So the 0.5 has to be multiplied times 100. Everything's got to be multiplied times 100. So that's that $50. Also, a delta of 0.5 represents a 50% chance of expiring in the money, which is actually pretty solid. A 50% delta for a contract is a solid delta. The more conservative you are when trading options, the more money you'll make. I will promise you that, y'all. Theta measures the time decay of a contract. In other words, every day that an options contract gets closer to expiration, it loses more value for every dollar it goes in the opposite direction of the desired strike price. And so what that means is the closer you get to that expiration date, the higher theta is going to be. That's why we like trading contracts with time on them. That way we can eliminate theta out of the equation entirely. Theta won't even come into the play. Now, implied volatility. It measures violent moves in an asset either to the upside or the downside. Heavy buying or selling in the market will increase volatility. Events like earnings reports, Fed's interest rate decisions, and major news about companies will increase volatility. Also, the closer the contract gets to expiration, the higher the volatility will be. Now, implied volatility, this is another one. This is another reason why we like to trade contracts and get out of them long before they expire. That way we can remove the implied volatility and it won't mean that much to our contracts. Now, ITM, I've been saying ITM a lot. This is my favorite position because being in the money means the price of the underlying asset is above the strike price when trading a call and below the strike price when trading a put. These contracts are the most valuable and generate the most money for every $1 movement in the stock price. Think the delta. The delta is going to be very high and it's pretty much going to move. Once you get in the money and you're getting deep in the money, what's going to happen is that contract is going to be moving dollar for dollar. It's going to be moving dollar for dollar for how the stock moves, which is great because now you've got intrinsic value built into the position. We'll talk more about that. Being out of the money means the price of the underlying asset is below the desired strike price when trading a call and above the strike price when trading a put. ATM, at the money, not automatic telling machine. Being at the money means the strike price is exactly that of the underlying asset stock price. Now, some more keys. Ask. Okay, when you're looking at the options chain, okay, the ask is the price at which you buy the contract. That's what the market's trying to sell it to you. It wants to sell it to you for the ask price. The bid price is the price at which you sell the contract. That's what the market wants to give you for the contract. Now, the spread is important because the spread is the difference between the ask and the bid. and you want the spread to be very tight. Okay, when you purchase a contract, you want the price you execute to be as close to the bid as possible so you can be in profit as quickly as possible. You'll understand what that means once you start trading, because you're going to trade and you're going to make money. Okay, you can control the price you pay for a contract by placing a limit order. What is a limit order? A specific price that you set to purchase a contract. We're going to talk about more of that in depth. What is a market order? A market order is an order that will be executed at the current market price, whatever the ask is, whatever the market wants to give it to you at that time. Market orders offer you the ability to instantly enter a contract, but it's likely you will get in at an unfavorable price. You only want to do market orders when the spread is really tight. And I'm talking about like 5 cents on the premium, 3 cents on the premium, because volatility is very high, volume is probably very high. You can probably get in at a pretty good price. But if that spreads like $1 or more, $2 or more, $3 or more, you have to put in a limit order based on how that contract has been trading. Open interest. Open interest is the number of contracts that are held at a specific strike price. Okay. High open interest is important to have when selecting a strike price. That means it's very good demand for the contract that you want to trade. And we want to trade contracts that have good demand. That's going to be very important for us continuing to make money and build wealth in the market. So we talked a lot about trading options. Okay. We talked a lot about trading options. So what are leaps? Okay. What are leaps? Leaps are long equity anticipation securities. Okay. In layman's terms, these contracts have expiration dates that are 1 year or longer from the date you purchased the contract. Okay. Some leaps can be up to 3 years or longer in some cases. Okay. Selecting contracts that are 1 to 2 years from expiration is where you want to begin surfing the chain. Okay. That's when we're going to start surfing the chain. When you're trading options and you're trading leaps, you are worried about the options chain, seeing what the volume is, seeing what the price of the contract is going to be, so you can exploit opportunities in the market to surf the chain. Now, trading longer dated options allow you to benefit from the prolonged trend of an underlying asset. Okay. Also, you get the benefit of having time on your side and allowing your thesis to play out, so you don't have to worry about the day-to-day volatility of the market. Eliminating theta, eliminating implied volatility is going to hurt your contract the closer you get to expiration. The effect of theta is very minimal when trading options. That's what's so good about it. But when trading leaps, specifically, and typically the returns you can expect on leaps are 100% or better. Now, I have to put this right here because I have to give you an expectation of what to expect. Okay. Typically, the returns you can expect on leaps are 100% or better, but I don't want to sell you a dream here. So what are the cons of trading leaps? Okay. What are the cons? Okay. The premium you will pay is larger than that of shorter dated contracts. So a lot of people like to trade weeklies. They like to trade shorter contracts because they're cheaper, right? That day traders like to trade weeklies, okay? But this is what I will tell you, and this is what I believe. This is just my opinion. An expensive premium is the price you pay for quality. Okay, be conservative, y'all. You make money when you're conservative in this game, and that's just how I feel. The capital you put to risk will be tied up for longer periods of time with no guarantee of a return. So these contracts are 1 year, 2 year, 3 years long from expiration. You're putting your money up, you're putting your capital up to get a return. But if we're in a bear market for a long extended period of time, that could put you in a bad situation. So you want to keep that in mind for what you're buying. Options are very volatile and they can move very violently. I cannot put it into words how trading them will make you feel. Okay. I can't describe it to you in words. The words won't do it justice. You have to put your money on the line and experience it for yourself, because that's just how options move. A lot of people aren't familiar with options. And so my goal here as the host of the Trade for Yourself podcast is to give you the proper knowledge and give you the proper tools to trade them effectively so you can make money. Okay. Now, this is what I'll tell you, and I really want you to understand this. You must be willing to lose money in order to make money. I'm going to say that again. You must be willing to lose money in order to make money. Why is that? If you are not willing to take risk, you will always be working for somebody that does. In addition to that, if you are not allowing your money to work for you while you are sleeping, you will literally work until you die. You see, the mission here for the Trade for Yourself podcast is to help you learn how to trade and invest in the stock market for yourself, but also to help you create the plan that you need for wealth building. I want you to get to a point to where you can, if you have a job, if you're an entrepreneur, whatever you are doing, I want you to be able to have that nest egg so you don't have to be worried about making money and have to work for long periods of time. And so that's what we need to understand. Look, when you're trading options, we need to understand that we need to lock in and we need to know how to trade. But they are volatile, but it depends. But how you view volatility, is based on what side of the volatility you are on. Understand that. I'm telling y'all, this is what's going on. I wish I knew all of this prior to the COVID crash. Look, I'm telling you right now, the market, we are in a bear market. This is your second opportunity. I'm just going to be 100% honest with you. What the market is going through right now, this is your second opportunity to tap in with these leaps. Now, start light. Okay, start light. Okay. Your first trade should only be 1 to 2 contracts. You don't have to go crazy because, like I said, I can't do it justice on how much money you can make or how much money you can lose. So what I want you to do is just to start light. When you start light, it'll give you the opportunity to learn the process. That way you're not losing crazy amounts of money. All right. Now, trading options versus buying shares. Okay, what's the difference between trading options and buying shares? And what's really the benefit? Like, what's the benefit of trading options and trading leaps in general? Now, trading options allow you to obtain a much greater return than purchasing shares by using less capital in order to do so. Let's do the breakdown. Let's say you purchase 10 shares of a stock, and let's say that stock is trading for $100 per share. The total investment that you put up is $1,000. If the stock appreciates to $110 per share and you sell all 10 shares, you'll make $100. That's good. You just made $100. Now let's take the other side. Breakdown number 2. Let's say you decide to purchase one options contract with a premium of $10. Remember, everything's got to be multiplied times 100. So the $10 per contract times 100 shares, that's $1,000. Notice it's equivalent. You invested $1,000 over here on the share side, and then you invested $1,000 over here on the option side. The delta on the contract is 0.5. 0.5 times 100 equals $50. Remember, everything times 100. If the stock appreciates to that same $110 and you sell the contract, you'll make $500. That's like 5x return on your money. That $50 delta times that $10 appreciation, that's $500. Now imagine if you had 2 or more contracts. The compounding can start to get very attractive. But just remember, negative compounding can happen in the opposite direction as well. That's why I always reiterate, we got to be conservative with this thing. Now, also, this is not meant to show that trading options is better than buying shares. I believe the combination of trading options and buying shares can be very lethal and valuable. Okay. I think you need both. A lot of times in society, we make competitions with things. We make competition about, is real estate better or is the stock market better? Is starting an e-commerce business better than starting up crypto? Is having a restaurant better than owning a vending machine? There's no competition. We need both. You need to be adding money to your long-term account every single month. Trade options, get your profits. take your profits, reinvest back into the options portfolio, pay yourself, put some money into your long-term portfolio, rinse and repeat, right? Like, I want everything, y'all. I want to use everything. I want to be financially unbreakable. I want to be all that in 2 bags of chips. And so what I want to tell you is that we need it all. We need it all. And leaps plus shares equals my wealth formula. This is my wealth formula. This is what I want to use to build the foundation for the wealth. Everything else is going to be built on top of it. Now, let's talk about CBOE, CBO. Let's talk about CBOE, all right? CBOE stands for the Chicago Board Options Exchange, okay? It's the world's largest options exchange with contracts focusing on individual equities, indexes, and interest rates. So they created the options. They pretty much are responsible for creating options, okay? CBOE is also the creator of the VIX. The VIX is the CBOE Volatility Index, and it's the most used and recognized proxy for measuring market volatility. The VIX measures the volatility of the S&P 500. And so if you look at what happened to the market yesterday, the VIX was up. It was up, I want to say it was around 27, something like that. Don't quote me on it. Now, the CBOE is responsible for the release of expiration dates for options contracts. We're going to talk about why this is important on this next slide. Now, this next slide is the 2022 options expiration calendar. And so if you can just look, I've got a red box around 2025 equity leaps added, and they were added on September 12th. Okay, September 12th was when new leaps were added. These were January 2025 expiration contracts, okay? That's pretty much your 2.5-year position. You get into that 2.5-year position, you can ride that out for a year and a half, sell for your profit, rinse and repeat, okay? So the CBOE is, we use the CBOE to pretty much see when new contracts are added for certain stocks, certain indexes, whatever you want to call it. And so we want to care about when these new contracts get added. Now, quadruple witching, QW or QW. Now, quadruple witching occurs on the 3rd Friday of the last month of each quarter. QW represents the major expiration of options contracts and futures contracts. Also, more expiration dates for options contracts and futures contracts are typically released during this period. Quadruple witching happens 4 times a year. It happens in March, June, September, which is this month. Quadruple witching is this Friday, and December. Typically, there's more volume and volatility present in the market because of this. The volatility doesn't necessarily happen on the quadruple witching date, but the volatility could occur a couple of weeks prior to QW or a couple of weeks after, creating a quadruple witching period. Now, the S&P 500 was down 4.3% yesterday. Over 100 million shares were traded on SPY, ticker symbol SPY, the ETF that tracks the S&P 500. That's the most volume we've had in almost 3 months. Like I said, more volume, more volatility tends to come around this time frame. Now, it doesn't mean that we're necessarily going to experience corrections during QW all the time, but QW does historically occur during 2 of the worst months in the stock market historically, March and September. Now, check this out as well. Let's just think about what happened in 2022. In March, the market was down. In June, the year-to-date low for this year occurred in June. September, worst day since 2020. You see what I'm saying? You see the consistency around QW is volatility, because everybody has to get out of options contracts and futures contracts and get into new contracts. And so QW is a time to manage existing positions and start new ones, so we can practice good active portfolio management. Now, this right here, this is the options chain. Now, when I'm pulling something up like this is when I start surfing the chain, okay? E-Trade is a brokerage that I like to use for trading options. Now, what we're looking at is we're looking at the January 2024 expiration for ticker symbol XLK. If you don't know what XLK is the technology ETF of the S&P 500. So what that means is that every single technology company that is classified in the technology sector is in the S&P 500. The three largest stocks in XLK is Apple, Microsoft, and NVIDIA. Apple and Microsoft make up over 45% of the ETF. It's a market cap weighted ETF. And so the reason why I like trading XLK is because if you put XLK side by side and you put the S&P 500 side by side, it would be hard for you to tell which is which. The volatility and the returns would be different, but they move about the same because of the top two positions in XLK are the top two positions in the S&P 500. That's why I like trading tech, because tech, we cannot get a positive return in the S&P 500 without tech. It's not going to happen. We're not going to get a positive return on the S&P 500 without tech. And that's something that I really, truly need us to understand. Now, I've got some red boxes outlined, and I want to show you guys some things. So at the top, there are calls and our puts. We've got trade, quote, last bid, ask, strike price, everything that we've been talking about up to this point, open interest, volume, strike price, right? And also at the bottom, I've got the 140 strike price highlighted, okay, the $140 strike price. Now, if you look at this strike price interests me for calls because it's the third largest in terms of open interest, in terms of contracts. Like I said, we want the open interest to be there. We want demand. We want demand for the contracts that we trade, okay? On top of that, the bid and the ask is tight. That spread is tight. If you look at the 139 call right above it, the ask is 21 and the bid is 17. That's a wide spread. And so that's going to give me that's going to make it hard for me to get into the position. But what I want us to look at is one thing we need to introduce is the last price. The last price. We've got the bid price, the ask price, and the last price. The last price is literally the last price that the contract was sold for. And so if you look at the 140 strike, the ask price is $18.20. The bid is $18.10, but the last price was $15.30. That's a big spread between the bid and the last price. And so for this particular contract, I would want to put in a limit order for around $15 because that was the last price it was sold. Like if you look at this, if you look at the top right, I hate that I didn't put a red box around that top right. If we look at that, XLK was up almost 2% on the day. It was a very, very green day for XLK. The reason why the bid and the ask is higher is because of green. It's because of the green, right? So when we have green days in the market, calls are more expensive, puts tend to become cheaper. When we have big red days in the market, puts tend to be more expensive and calls tend to be cheaper. So if you want to go long on an options contract, you buy your options contracts when the market is red to go long. If you want to short, you buy your options contracts when the market is green to trade puts, okay? It's got to be an inverse correlation with it. Now, let's look at some more finer details. Now, this is the January 19th, 2024 expiration 140 call. So what that means is that this pretty much, when you read it, it means that this contract for the strike price of $140 is going to expire in January of 2024. That's more than a year away. We need contracts that are at least a year away. So you got the last price, which is $15.30, the bid price, and the ask price. Now let's look at this chart. Let's look at the year-to-date chart for how this specific contract has been trading, because this is what we want to look at. When we're trading options contracts, we're trading leaps, we need to look at them as if we're trading them as shares. Okay, we need to get them on discounts, and we need to see how the contract has been trading. Now, in January 5th, 2022, the price of this contract was $52. Multiply that times 100, that contract is $5,200. But understand what that coincides with. That coincides with the all-time high in the stock market, because during that time in January, the stock market was at 52, was at an all-time high, and this contract was at $52. Why was this contract at $52? Because this is a $140 call, and XLK was at $177 at that time. $177 deep in the money. Remember what I said? My favorite position is ITM, in the money. And so you do not, okay, I repeat, you do not want to buy contracts at all-time highs. You don't do it. You buy contracts when the market is down. Buy contracts when the market is down. That way you can get the value. Look at this box here on the right. Okay, we want to read charts from right to left. We read charts from right to left because more recent trading activity happens from right to left. And if you look down here on the right, this gives an opportunity to look at some things. Look at some things, and we can get it on a discount. Let's go to the next slide. Now, this is a 3-month chart of this particular position. Now, I have drawn some red lines down here on the chart, marking support and marking resistance. Now, remember what I said before. I said that typically when you trade leaps, okay, you can typically expect to get 100% returns on your position. Okay, 100% returns on your position. And what I also said too is that it's no guarantee. It's no guarantee with that, but you can expect a 100% return on your position. Remember this, when you're trading leaps, we have to know how to trade. We have to know how to trade so we can actually get that 100% return. So we buy at support and we sell at resistance. So remember what we were talking about before. The year-to-date low that we had in the market occurred in June. If we look back in June to the left, this contract was trading around $12.50. That's the 52-week low for this contract. If you look at the volume it wasn't that high during that time, but you can see a double bottom, really a double bottom on this contract, okay? That is a bullish sign, that double bottom, and that's us buying right at support, that $12.50, okay? $12.50. In August, we had a great return for the first half of August, but we ended up losing it all because of what Jerome Powell said at the Federal Reserve meeting in Jackson Hole. But if you look at that, you could have sold that contract for $28 right there. That's a 100% return. You just made over $1,000. You just made over $1,000 in 2 months. Okay, that's how you make a 100% return trading options. You could have took profit, and you could have waited for it to come back down to that $15 mark where it is right now. So what you could have done is, if you had 2 contracts, you could have bought both of those contracts around the support area. Wait till it gets to 100%, take profit on half. Take profit on half. Now you just made 100%. Now you're in the trade for free. Now you got that capital on the side to wait, because the market is running very hot. It's running very hot during that time. Also, on top of that, you've got till January 2024 until this position expires. So now you got time to wait. Now you got time to see what's going on in the landscape. You sold half your position at this resistance point. It comes back down to 15. Now you can consider re-entering the position. Because if you still believe, and if your thesis still believes that XLK can reach $140 and exceed $140 by the time we get to January 2024, or really before that, because like I said before, we want to be out of these contracts way before that, June 2023, July 2023, August 2023, that means that pretty much this contract right here is still valid. This is the power of trading leaps and trading options, because now I'm not worried about theta. I'm not worried about losing the value of my contract. And I'm not worried about implied volatility from a day-to-day perspective. Now, this is pretty much the 140 strike. This is what you'll look at when you look at the options quote. Okay, when you look at this options quote, and this is E-Trade. And I really like E-Trade. Okay, you got the day high, the day low, the open, previous close, days to trade. You got 497 days until this contract expires. 497 days. That's plenty of time. Okay. Deliverables for this contract. Remember, each contract is 100 shares. And the two I want to point out is delta and theta. Delta is 0.58 on this contract. That means that for every dollar this contract goes up, it's going up $50. Okay. Delta is also, remember, the percentage chance that is going to expire in the money. And this is the one thing I want to tell you. Delta measures the price increase for every dollar increase. But as the price of the stock goes up, Delta goes up with it. So as the stock gets closer, so as XLK gets close to $140 per share, Delta will also increase with it. Look at theta. Theta is negative 0.015. Okay, that's doing nothing. Okay, imagine if theta was 0.32. That means for every day, every negative day, theta would be losing $32 on the contract. That's why we're trading leaps. We're trading leaps to give us the time to let our thesis play out. And if we're being conservative, it allows us to do what? It allows us to make more money in the long run. Now, the next two slides are going to be pretty important. Okay. How do you choose a strike price? Okay. It's not really an arbitrary thing. As you get more experience into trading options, you can pick strike prices without actually having to use formulas. But as you get started, you want to have a basis. You want to have something you can look at and say, how did I pick this strike price so I can be conservative? Now, remember, the key to trading leaps is having time. Ideally, we want to sell our positions for a profit and cut the expiration date in half. Okay. If you purchase a 3-year position, look to sell it in 1.5 years. If you purchase a 2-year position, look to sell it in 1 year. If you purchase a 1-year position, look to sell in 6 months, etc., etc., etc. Now, when selecting a strike price, use the 10-year average annual return as the metric for selecting a strike price. What does that mean? That means that whatever the average return for that stock is over the last 10 years is what you want to be using as a metric for selecting the strike price. Let's look at the breakdown. Let's say the current stock price is $100, and let's say the 10-year average annual return is 20%. You would take that 20%, divide it by 2, and get that 10%. So when you get that 10%, your formula would be the current stock price times the expected return. So your strike price would be equal to $100, which is your current stock price, times 1.10, because we took the 20%, divided it in half, and to get that 10%, we'll just take 1.10. That's our expected return. And the strike price we would look to get is $110. Now, remember, I said conservative. So, for example, if the stock price is $100 and you get a 2-year position expecting the return to be $110, the first thing you will probably tell yourself is like, man, that's very conservative. That's a very, very conservative strike price. But when you first get into these options contracts, I want you to be conservative. Why? Because if you be conservative, that gives you the ability to recover if something happens in the market and if you make a mistake. Okay, this is just something you can use as a basis, as a metric, so you can know exactly what you're doing, so you can have confidence in picking strike prices. But as you trade options more, you will get a feel for how to trade options. For example, that $140 strike price, you'll kind of feel that's a good strike price to look at, especially if I'm trading for a year and a half out, right? So you can use gurufocus.com to find the 10-year average annual return for stocks. You can use E-Trade to find the 10-year for ETFs, which are what I recommend you starting your journey with. Start with XLK. Start with XLK. That would be a perfect place to start. You can use barchart.com for price performance reports and for so many other cool option tools. That's going to help you. That's going to help you, give you the tools to help you understand what you need to be successful. And so remember, we're starting with the ETFs because the ETFs are going to move slower than the stocks are, right? The ETFs are going to move slower than the stocks are. And so it's gonna help us be even more conservative because look, I want y'all to make money. I really truly want y'all to make money. I got some comments in the chat. I hate math. Look, this is very simple math. Okay, this is very simple math. Like I hate to put this math up here, but I gotta give y'all the tool that you need to be successful. Look, I really truly want to help y'all. So please reach out to me. I'm here as a resource to help y'all. Okay, I'm here as a resource to help y'all because this is the time that we need to be looking to go long. We need to be looking to go long right now. And so this is always going to be a resource you can come to and check. Now, how do you place an options trade? Okay, to place an options trade, you find the place on your brokerage app or your website to place a trade. Make sure you are selecting options and not shares. Okay, make sure that you're surfing the chain. All right, you're surfing the chain. Okay, when purchasing an options contract, you will select buy to open. When selling your contract, you will select sell to close. Okay. You will then select the type of order you want to place. I recommend choosing a limit order. And then you will enter the premium you are willing to pay for the order. Okay. Select how long you want this order to stay open. If you want it open for 1 day, select a day. If you want the order open for a longer period of time, you can typically have an order open for a period of 60 days. Now, why would you want to have an order open for a period of 60 days? Let's say you bought a contract at $5 and you just want to say, hey, I'm gonna stay disciplined. I want to be out of my position at 100%. I want to sell at least half my position at 100%. If you bought the premium at $5, you can automatically set an order to sell half of it at $10 or whatever price you want. That way, the emotion of trading will not make you sway. Like when you see the position going to 125% and 150%, you won't say, you know what, I'm gonna let it run a little bit. You'll take that profit at 100% without having to allow your emotions to make you second guess, right? If you're waiting on an options contract to get to that 52-week low and it's been getting beat to sleep, you can set that specific order. If you only want to pay $10 for a contract and you know and you believe it's going to come down to that 10, you just wait. You put that order in and you just wait. And then you execute the trade. Now, if you have any questions about how to execute a trade, please call your brokerage firm, y'all. Please call them. Most of them are open 24 hours, 7 days per week. It's free to call them, y'all. It's free to call them. And you can ask them any question you want about how to use the platform. They make money from you and they are paid to make these services available to you. I promise you won't regret it. Like you won't regret it at all. Some brokerages I like for trading options are E-Trade, TD Ameritrade, and Webull. Also, make sure that you have level 2 options trading available when opening your brokerage account. If you don't have it on an existing brokerage account that you already have, call your brokerage firm and ask them to give it to you. If they won't give it to you, find one who will. We will not let one brokerage stop us from what we need to do in order to build wealth. Use the tools that we have at our disposal to help us make money in the stock market, because I'm telling you, call your brokerage. They will actually give you game on how to use the platform. they'll put you in position, and because every single brokerage account has different wings, different categories, they have different groups that help with certain things. Use them to your advantage. They're open 24 hours, 7 days a week. I called my brokerage one Friday night at 10 o'clock and they answered the phone. And so remember to use them as a resource. Now, are there any questions? Are there any questions? Look, reach out to me in the chat right now. If you have any questions, please ask questions. If you have any questions, please reach out to me in the chat. While I'm waiting on people to reach out to me in the chat, I really want to let y'all know, I really want y'all to understand that trading options is a powerful tool. It's a very, very powerful tool that we can use in addition to our portfolio. Okay, very powerful tool that we can use in addition to our portfolio so we can make sure that we are building the wealth for the long term. Remember what I said. Remember what I said. My wealth formula is leaps plus shares equal my wealth formula. Okay, I want to use the combination of trading leaps and buying shares to help me build wealth, because whenever I'm buying shares, that's an investment. I'm buying the car. Okay. And I can hold on to those shares as long as I want to, as long as I see value in the business, as long as management is performing well, as long as they're helping out with products, as long as profit is increasing year over year, revenue is increasing year over year. They're continuing to have strong management, strong balance sheet, strong cash flow. You know, they're continuing to grow the business. They are being a leader in their industry. I can hold on to those shares as long as I want to. I can collect dividends. The company decides to pay a dividend. I can do whatever I want. But when I trade these options over here, though, these options give me control. And they give me the opportunity to get a greater return without having to put as much capital up in order to get it. But like I always say, this is not guaranteed. And so this gives me an opportunity. Like I said, you can trade leaps. You can trade leaps and it can be very, very powerful. But you really, truly have to know how to trade and know what you need to do in order to be successful. Okay. You have to know how to trade in order to know what to do and in order to be successful. So look, as always, like, I appreciate everybody for tapping into this episode and allowing me to teach y'all about how to trade options. Please like this. Please subscribe. Please share this, okay? If you really, truly see value in this, I really, truly want you to share this out with multiple people, okay? If you need help trading options, I'm here as a resource. You can reach out to me on Instagram, Mr. Devon Elder, MrDavonEelder. You can email me at tradeforyourself22@gmail.com. You can go to www.tradeforyourself.com. While you're there, you can pick you up one of these nice t-shirts and you can fill out and you can go to the contact tab. Go to that contact tab, put in your question, and I will make sure that I answer that response on the podcast, because this is very, very important. Do not let any questions or anything that you need to go unanswered, because we're here to build wealth together. So I appreciate y'all. I thank y'all. And remember, don't pay for it. Trade for it. Catch y'all in the next one.